Okay, we're going to go ahead and get started. We had about 50 RSVPs, but it's lunch, so a lot of people get here a little late. So welcome, Grace Frank Group. I'm Grace and Eddie. We're doing the overview today. Our concept today is about exit strategies for investors. And so we hope it's very valuable. And Eddie, here you go.
Yeah, good. So appreciate everyone coming out today. My name's Eddie Bodkin, and I started out in real estate about 9 years ago. I was negotiating short sales and wholesaling. I did that for my first couple years. Then after that, I got into rehabbing. At some point along the way, I got a real estate license. Been focusing a lot on that the past 2 or 3 years. Now I'm moving into the new construction. So that's just a brief overview of what I've done just since I started. But what we're going to do today is we're going to talk about just 5 of the top investment strategies for investors. So we're going to go over an overview of each and then just talk about just some best practices on things that you can implement in your business. So the first strategy we're going to talk about is wholesaling, and that's how I started. And we're just going to go over just some tips and strategies on wholesaling, just talk a little bit about what it is, talk about just how to put your wholesale deals together and how to put them together and bring them all the way to close. So wholesaling, it's acquiring a contract from a seller and then you assign the rights of your contract to a buyer. So what that means is that you're selling the contract. You're not selling the property. You're selling your rights as a buyer to that contract. So when you assign that contract to another buyer, that buyer takes your place, and then the buyer is the one obligated to close on that contract. It's one of the best short-term strategies, and it's a good way to get started. So you see a lot of people, do like what I did, and they use wholesaling to get started. It requires typically very little capital to get started. Now that's just looking at just if you do just a couple of deals, you really don't have to have really any money other than a deposit to put down in order to do a wholesale deal where you assign a contract. Now, if you make it a business, you have to have capital. You got to have money for marketing. You need to have money to close on deals, because some wholesale deals, you may not be able to assign the contract immediately, but it could make sense to take private money and close on it and then resell it a few weeks later. So it is a good way to get started, but if you make it a business, you do definitely want to raise private money and also have money available for marketing your campaigns and keep that consistent, because that's how a wholesaler has a business, is consistent marketing and lead generation. And the overall idea is you're generating income by finding and negotiating profitable deals. So that's really that's the life of a wholesaler, is you're marketing and negotiating with buyers and sellers. So we're going to talk about the structure of an assignment of contract, which is the first way that you can wholesale a property. So you get a property under contract, find a property that you can negotiate a discount, get the contract, and then you market the contract, not the property, you market the contract to your buyers list. So that's typically the first place you start, assuming you already have buyers in place that you're going to sell the property to, or the contract. And then typically you want to have a marketing plan, so it's not just send it to your buyers, it's also do things like post it on Craigslist, Zillow, Facebook Marketplace, other places online. Sometimes you see even some wholesalers that post bandit signs that have information about properties they're selling. So those are all strategies to either sell your property or just simply build your buyers list. So once you have a buyer, then you typically will take a non-refundable deposit, and then from there, your buyer will close on the property. So the reason you want to get a non-refundable deposit, and you'll see this with most any wholesaler that's selling their property, is because you don't want the buyer to be able to back out easily. So it's usually no inspections and non-refundable deposit. Now, it doesn't mean that your buyer can't look at the property, because that really wouldn't make sense. You want to give your buyer the ability to still do his inspections, but he does it before you go under contract. So in other words, you just say, hey, look, go and inspect the property all you want, do whatever you have to do your due diligence, but when you decide you want it, then it's a non-refundable deposit, and there's no inspections, and that's how I have my contracts written. So usually what you'll do is you'll take part of your assignment fee as the deposit that your buyer gives you. So if the buyer bails out, then you've still got your part of that assignment fee that you keep as a non-refundable deposit. Then you go and find another buyer and try to get it closed before your contract runs out with the seller. But that still allows you to be able to still make something off of the deal, if your buyer doesn't close. But typically it's going to be you get part of the assignment fee with your down payment or your deposit, and then you collect the rest at closing. You don't necessarily have to do that, but that's always the way I've done it because I want to make sure everyone's happy. I want to make sure that the seller that called me and said, hey, I want you to buy my house, I want to make sure it goes to the closing, because if that buyer doesn't close, then what's going to happen? Well, they're probably going to blame you. So you want to make sure the seller, because they called you to sell their property, you want to make sure that they're taken care of. Well, the same thing with your buyer. I mean, let's just say if your seller got anxious and didn't want to go to the closing, well, that buyer's already given you the deposit, and what if the seller doesn't show, or what if something happens on that end? And that could be more than likely a buyer that you would do business with over and over. I mean, that's how I work my wholesale buyers and my investors. Is I usually sell properties to my top 10% of my buyers, or at least most of my properties. So you want to make sure that buyer's taken care of as well. So I have always, when I do a wholesale deal, just stay in the middle of it and collect part of my deposit or part of my assignment fee when I get the deposit from the buyer, and then the rest of it at closing. So that's an assignment of contract, and again, you're just selling the contract, you're not selling the property. So there's only one transaction. So your buyer takes your place on the contract, and then the property closes, and it's just one transaction, and you get paid an assignment fee. Now, for some of you that may think, well, what's the difference in that versus what a realtor does? And I'm also a realtor, by the way. There's actually a big difference, because when you're acting as a wholesaler, you are the buyer. Until you assign that contract, you're obligated to that purchase and sale agreement. You are the buyer on that contract, and you're obligated to the terms of that contract. So you're a principal in the transaction, whereas a real estate agent is not a principal in the transaction, just acting as an agent. If they act personally, then they are, but if they act as an agent, then they're not. They're just bringing buyers and sellers together. They're brokering a property. They're not acting as a principal by getting a property under contract. That's the main difference. So ultimately, the wholesaler is actually acting in their own self-interest. It's their property or contract that they're selling, versus a real estate agent is more about the representation of one or both parties, or facilitation. So when you look at a double closing, that's the second way that you can close a wholesale deal, and it's two transactions. You're not assigning the contract. You're getting one contract with the seller and a separate contract with the buyer, and there's two closings. And the reason for that typically is that if you buy properties where a bank is involved, like when I started out, I was negotiating short sales, so a bank was involved. We had to get approval from the bank to get the price approved and to close the property. So if it's a situation like that, or you're buying a property that's a foreclosure, you cannot assign those contracts. So the way that you do that is you physically buy the property and you resell it to your buyer, typically within the same day. The other reason you would do a double closing is if you just have like a really big profit and you don't want either party to really know what you're going to make, because on the assignment of contract, they're going to see what you make. I mean, it's all in the settlement statement. It's going to have your assignment fee. So both parties will see what you make. But with a double close, it's two separate transactions and nobody knows. So that would be the other reason to do a double closing, is if you just have a really big profit. The other reason might be like I said before, if you just see a property that's just a fantastic deal, you know that you can close on it and resell it quick, but you don't really have time to market it to your buyers list, but it's a really good deal. And you can either put it on the MLS and sell it, or just sell it within a few weeks, but you have to close. That would be the other reason to go ahead and just buy the property and resell it. So typically it is purchased and resold within the same day, and you're lining up both parties and bringing both parties to closing, and the transactions, the closings are back to back. But it doesn't always have to be that way. It's still considered a wholesale deal or a double closing. Even if you buy the property and 2 or 3 weeks later, you sell it. It's still the same thing. You're selling it as is. You're selling it to an investor. It's still a wholesale deal. So here are some wholesaling best practices. Just some things to look at. If you are working on, if you are wholesaling or you're working in that direction, then these are some things just to keep in mind to make it better and to make it work more efficiently. Well, by the way, is anyone here wholesaling? I know Thomas. Is anyone else doing any wholesaling, or have you done any wholesale deals recently? Okay, a few of you. Okay, cool. All right. So these are some things just to just to take note of, and to that can help you with your wholesaling. So really, one of the main things is building a buyer's list. Now, there's kind of two different ways to look at that. One is, do you want really a big buyer's list? Do you want more of a quality buyer's list, or a little bit of both? I mean, I kind of lean more towards a little bit of both, even though I focus more on my top 10% of my buyers. Still, having a big buyer's list can still help, because there's some buyers that may buy 1 or 2 properties a year, and maybe another year or two goes by, they don't buy anything. So they kind of, just miscellaneously buy properties, but you can still, over a period of so many years, still consistently sell properties to a buyer like that. So overall, yeah, it's good to grow your buyer's list as much as you can. But at the same time, typically it's going to be a better practice. It's going to be more efficient to focus more on your top buyers, and just because they're repeat buyers and they buy multiple properties a year, and focus more on that versus just as many people as you can sell a property to. But just building the buyer's list is really the key. I mean, that's the wholesaler's biggest asset, is your buyer's list. Implement multiple marketing campaigns. And this is one of the things, because I coach new investors on a regular basis, and this is one of the things that I see people kind of stumble up on, is just really understanding how much marketing you have to do as a wholesaler. Like, if you just have one marketing campaign, you're probably not going to do very many deals. I mean, there are strategies you can do that are low cost or even no cost. I've done a lot of those strategies, but if you don't have multiple campaigns going for buyers and sellers, you're not going to do a lot of volume. So you have to really be able to systemize that, and you have to be able to manage multiple campaigns to be able to get enough leads to close consistent deals. And this is another big thing, especially people that are like just getting started, is understanding how to evaluate properties correctly. Now, like, one of the questions I get from people that are newer investors is, do I have to know all that stuff to wholesale? Meaning, do I have to know how to evaluate properties and estimate repairs and really the rehabbing side? And the answer is yes. The more you know about that, the more value you're going to bring to your buyer, for one, because you can pass all that on to your buyer, and also you're going to be able to negotiate better deals. So if you really don't understand repairs, you don't understand the rehabbing portion, evaluating properties, determining your ARV, looking at your repair estimate or how much repairs will go into a property, you're probably not going to negotiate a good enough deal in most cases for a buyer to want it. So it's very important to really look at that property like your buyer would see it. And this kind of goes hand in hand with knowing how to evaluate a property, which is, don't offer more for a property than what you can pay. Like, don't think that, I've just got to do a deal this month to pay my bills, and you offer too much, and you end up spending time on a deal that falls apart anyway because you offer too much. You didn't make any money. So you want to make sure that you're evaluating the properties the right way and not offering too much, because you have to also consider that if you're going to sign that contract for $5,000, $6,000, $7,000 or more, well, you've got to be able to negotiate a good enough deal to where you've got your profit and also your buyer has a good deal. And another thing is have the intent and capacity to close. So there's a lot of things we can talk about there, but basically it's, you don't really want to get in a situation where a seller says, hey, they never even had the money to close, they were just trying to find a buyer, they weren't even a legitimate business. So you want to be able to again, evaluate properties, typically have a good buyer's list in place, have private money in place to where you're not just backing out of a bunch of deals because you can't get it sold or because you've got it under contract too high, because that's what's caused wholesaling to come under scrutiny in a lot of different states. Ohio is one, Colorado is one. So there's several states over the past 2 or 3 years that have tightened up their just their regulations on wholesaling, because they see a lot of people jumping in and doing stuff to where it essentially hurts the seller and everyone else that's involved in the end, because they're doing work to try to put a transaction together, and then it keeps falling, or they have multiple offers that fall through if they're not evaluating properties the correct way, and and going into it with the intent and capacity to close. So it doesn't mean that every single deal goes through, because obviously you buy enough deals. I mean, there's some deals that don't go through. I mean, it's just the way it is. Sometimes you find something in the inspection that you didn't know about. Or sometimes financing doesn't go through, or even hard money. So I'm not talking about that. I'm just talking about not knowing enough about the business, and you go and just make a bunch of offers on stuff that's too high, and you have no ability to close if you don't just find a buyer before before your contract runs out. So it's just kind of another best practice, and really, even outside of the legal side, it's still it still just makes sense, because I've typically even when I started, I still would not go and make an offer on something unless I was almost certain I could close on it. So it's just good business practice as well. Let's talk a little bit about rehabbing. So that's acquiring a property that needs repair and then renovating the property and reselling it for a profit. So you're going to be able to leverage your team, leverage your network, so your contractors, your lenders, your title companies, inspectors, realtors. You still leverage those people when you're wholesaling, but even more in your rehabbing, because at that point, then you're leveraging your private lenders' money, you're leveraging the work from your contractors, and then if you have somebody that's managing your projects for you, you kind of leverage that. So you can really leverage a lot of people within those transactions to make better and bigger profits. Another thing about rehabbing is that when it's done right, it revitalizes neighborhoods and communities. So you're able to go in and take properties that are distressed, vacant. Maybe they're properties where there's people that are squatting or whatever. So if you go in and start renovating properties in these areas, like we see a lot of people doing, it makes the neighborhoods and communities better. So that's really one of the big things that rehabbing does, for your area. So the structure of a rehab deal: you get a property that needs work, get it under contract, you do your inspections. So then at that point, when once you look at your inspections, what you've got to do, you create a list of repairs, which is also a scope of work. And you want to get really detailed with this. You want it to be something where you're giving very specific instructions to your contractor on what they need to do. So it's more than just simply an initial walkthrough estimate. It's getting really specific, I want this specific type of faucet in the bathroom. I want this color paint from Sherwin-Williams. And getting really specific on everything that you do in order for your contractor to know what he needs to do. So then, once you have your scope of work, you get bids from your contractors, you hire your contractor. That's kind of another process too. I'm not going to go into a lot of detail about that, but the big thing is pre-screen your contractors, make sure they're on board with the way you run your business and the systems that you have. It's going to save you more potential issues later on. So take some time to pre-screen your contractors to make sure they're going to be the type of contractor that you need. So then you line up your financing and close. Manage your contractors through the rehab process. Then you create a marketing plan or hire a real estate agent to sell your property. So it's just kind of a higher level overview, but those are the steps of what you will do whenever you rehab a property. So best practices, one of the main things is, make sure you account for everything: your purchase price, your rehab costs, your holding costs, whatever interest or points you're paying to your private lender or hard money lender, your closing costs. So sometimes some investors kind of maybe skip over this, but it's important really to look at that. On a spreadsheet, look at, okay, here's all the costs involved. This is the amount of time that I'm going to take to do this rehab, 4 months or 6 months or whatever it is, and look at all the costs from start to finish. And that's going to, for one, it's going to help you to know what you're going to make. You're going to be able to predict that much better, and also it's going to help you with your offer price, because if you don't account for all that, you might offer too much. Then if you offer too much, well, then you may not make what you want, or you might not make anything. So you want to make sure that you account for all of those costs, because there's a lot of different things that go in that whenever you're rehabbing a property. So plan ahead and create a scope of work like what we talked about. Manage your contractors with good communication and the right documents. So that'll be things like a contractor agreement, which you can get. You can get those at office supply stores, Office Depot. You can really better to get your attorney to give you one to make sure it has all the right verbiage. But a contractor agreement will cover things like, what are the expectations for that contractor? It's, what type of insurance is he supposed to have? What is the basic plan for the rehab? So it just goes over a lot of the details of how you'll manage that contractor and what the expectations are. A payment schedule, that's kind of goes along with that. It's coming up with a plan. So you and your contractor work together to come up with a schedule. So what are you going to do in week 1? Demo is going to be outside painting the roof. It's going to be starting to frame part of the house inside, or whatever you're going to do. So you look at what are you going to do from week 1, week 2, week 3, week 4, and then you come up with that schedule with your contractor, and you pay him based on that schedule. And that's kind of the other parties. Just pay for work that's been completed. And a lot of times, or sometimes you'll have contractors that just want you to give them money before they start. But it's never a good idea to do that, because it could be maybe the contractor, if he's not worked with you before, maybe he's just maybe there could be a trust issue, and you can work that out just by talking about this beforehand. But a lot of times, if contractors always want money up front, it's many times because they are going to use that for another project, or maybe they didn't finish someone else's work and the money went somewhere else, and they're going to use yours to finish the other rehab. And if you've already paid them for part of the project, are they really going to be motivated to come back and finish? No. Or it's going to take a lot longer because they've already been paid for that work. So you want to make sure that you have a payment schedule. When the contractor completes that work for that week, you pay them, and pay them on time, and you should do that. But make sure you keep that schedule, and if you start working against your system, then you can get burned. Ask me how I know. So another thing is, reward your contractors with a job well done. So you could, if they really do a great job, maybe give them a little bit more at the end, or just reward them with, bringing lunch, a couple of times during the project, different things like that. I mean, it's just, you want to be able to incentivize people. You want to keep good boundaries, but at the same time, you want to be able to incentivize people to do a good job for you, and because you want everyone on your team to make money, right? This is another thing just to kind of be aware of, is to pay attention to the market and not overpay. Like right now, it's a very strong seller's market, and I was just talking to just a couple of people a few minutes ago about how I'm kind of taken back at the prices some people are paying, not just for like rehabs or fix and flips, but for just rental properties. Because like Grace and I, we sell a ton of rental properties just through our brokerage, and even just with what I've done as as an investor and wholesaler. The majority of my deals that I've wholesaled have been good rental properties. But now, it's interesting the prices that people are paying for what's out there. So I think it's important when you're rehabbing, especially you're going to fix and flip, you're not holding it long term. Really, don't try to buy it based on hoping that it's going to be worth a lot more in 3 or 4 months when you're done, because it may not be. It could be worth more, but you still want to buy it based on today's value and run your numbers based on what it's worth right now. Subject 2. So this is going to be where you just temporarily take over the mortgage payments of a seller until you resell the property or refinance. So the loan stays in the seller's name, then the deed is transferred to the investor or to the buyer. It allows you to leverage the financing in place to fund your deal. So you don't have to go and get hard money and pay higher interest. So maybe you're taking over payments on a loan that's got 5% interest. So you're going to save money there. So your money that you've invested, you're going to get a better return because you're not paying as much in points or interest. And if the seller is behind in payments, it can help their credit. So usually, a lot of times, subject 2 is really going to be a better strategy for people in pre-foreclosure because they're behind in payments. They're losing the property anyway, so they're a lot more likely to say, yeah, I'll just let you take over my payments for a bit and work it out. Versus someone that is not in financial distress, they're going to be less likely in most cases to let you just take over payments on their mortgage. You still can if they agree to it, but it's going to be typically a better strategy for people that are in pre-foreclosure. And so in that case, that's one of the advantages that you can tell the sellers, look, we'll take over your payments for a few months, we'll rehab this property, resell it or refinance once we're done fixing it up. And that's going to help your credit because we're going to bring the payments current. We're going to keep it current for the next 3, 4, 5 months. It's going to help your credit as opposed to it going into the foreclosure and that ruins your credit. So some best practices, be aware of the due on sell clause. It doesn't really happen that often, but it can. So just be aware that when you do transfer title and the loan is still in the seller's name, then most mortgages and deeds of trust have a due on sell clause, meaning that the seller, the bank or the lender can accelerate that loan and call it due, then everything, then it's in foreclosure, and they can demand payment. So just be aware of that. Typically, it doesn't happen, but it can. And you typically want to also have some kind of disclosure with your seller, letting them know that, hey, look, there is a possibility this could happen. Most of the time, it doesn't. You still want them to acknowledge that in writing, and talk to your attorney about that. And this goes along with disclosing the process to the seller. Let them know about the due on sale clause. Let them know of your plan and intent to either rehab and refinance or resell the property, and just give them make sure they have an understanding of what you're doing. There's a little bit of debate on this in terms of how long to hold the property. I've seen some people just take over subject to deals and hang on to it long term for rental properties. It can work if you do it right. Generally, it's still typically better to not hold it more than 6 months, just because that will decrease the chance significantly that the lender would call the loan due if you just hold it for a short period of time until you sell the property or refinance back out. Consider holding the property in a land trust. So that's one way that you can kind of get around the due on sale clause. It doesn't completely eliminate it in terms of the chance it would happen, but it can decrease the chance that it will happen, because if they happen to check the title and they see that it's in a land trust, well, they'll just think many times that the homeowners just set that up for asset protection purposes, like estate planning. So, and that's, it's less likely they'll look and see a different name or a company name or something like that, which would let them know for sure the title is transferred. But if it's in a land trust, they could look at it as, hey, they just set up some estate planning, and then the land trust doesn't show the actual ownership, so it conceals that from whoever looks at it. So that's kind of one way. If you do hold a subject to longer than 6 months, that is one way that you can do it. Yeah?
If you're putting it in a trust, you said land trust?
Yeah.
Is that the same as like a irrevocable living trust?
No, not really. I mean, that's the revocable trust is really more for estate planning, but a land trust is more or less it's really more or less for anonymity. It conceals the ownership, and that's really why investors use it. So it's a trust, but it's still the verbiage and the purpose of using it is a little bit different. So the revocable trust is to avoid probate, is the reason you would set that up.
Land trust would be more challenging to transfer the deed.
No, it's not really. It's just the reason that you're setting it up. The revocable trust is going to be for estate planning, avoiding probate. That's the primary purpose. A land trust is just a tool that investors use typically to conceal ownership for things like a subject to deal, or even just their own rental properties. I mean, you can have a land trust that has an LLC as a beneficiary, and then you own the LLC, but the land trust conceals the ownership of the LLC. So it's kind of another layer of protection. Is really all it is. It's just preventing someone from being able to look right on public record and know exactly who owns the property. Typically set up a new insurance policy. Probably the easiest thing to do on a subject to is just to keep the other policy the homeowner had in place, especially if you're doing it just short term. Set up a new policy of your own that will cover you or your company that buys the property. Make sure to stay current on the payments, and this is really important because if you're buying that from that seller, then you've got an ethical responsibility to keep the payments current. So, the worst thing you could do is let the property go and not make the payments, and then it messes up their credit, which is what they were trying to fix in the first place. So, so make sure that that you understand the deal, you've got the funds in place to keep those payments current, and just and keep up with what you've agreed to with the seller. Because technically, could someone just quit making the payments? Yeah. But what is that going to do? You do that to enough sellers, and then that's you're not going to be able to work with people because they'll know about that. Here we talk a little bit about private lending. So this is when an individual lends money on a real estate project using their savings or retirement funds. And so the private lender becomes the bank. And in this situation, someone else does the heavy lifting and the lender gets a really good return. The money is secured by real estate as opposed to stocks. It's not secured by anything tangible. With real estate, your money is, or with private lending, your money is secured by real estate. It's insured by your builder's risk policy. So it's secured, it's insured. It's also predictable because you have a promissory note with your buyer or your borrower, And so you know what you're going to make just through the duration of that loan. It's completely passive, meaning if you compare it to rental properties, which is also passive income, you're not dealing with tenants, toilets, and trash. Your income is completely passive because the person that you've lent the money to is doing all the work, and you're just getting the checks every month. So some best practices on private lending. Really, one of the main things is know who you're lending the money to. What is their track record? How many deals have they done? What have they paid other lenders back? So understand more about the person that you're lending money to. What is your level of education? So this might get a little bit subjective because it's like, are there really degrees in real estate? I mean, technically there are, if you go to a university, but just looking at just real world experience, there's people that, don't even go the college route and they make a ton of money in real estate because they know the business. So what level of education do they have in real estate? Do they have mentors? Did they just read a few books? Or have they gone to seminars? Have they really invested in their education? Because it can get expensive if you actually really invest in your real estate education. It can get expensive. So you want to know what level of education does this person have? What type of properties do they focus on? I mean, what is their specialization? I mean, do they focus on rental properties? Do they focus on new construction? Do they do rehabs? Do they do commercial? What is their experience and what type of transactions do they do? And then systems, that's really important. So when you're going to lend money to somebody, you want to make sure they have the right systems in place. So I tell my lenders, look, we've got the right systems in place to first of all, find deals that other people don't know about. Secondly, to analyze deals and make sure we're getting a good deal, which is, it's where you make your money is when you buy. We got systems for hiring and managing our contractors to make sure that process goes smoothly. We've got good systems in place to be able to sell our properties within the time frame that we've decided. So your systems are really important, and if you're going to lend money to somebody, that's something you want to look at is, do they really have a business set up? Do they have the right systems in place? Do they have the right track record? Do they have the right team? Because all those things are going to make a difference. And then the due diligence of the property. So you want to make sure that the person that you're lending to is sending you information about the property. Now, sometimes if you really have a good relationship with a private lender, they might just say, hey, where do I wire the $100,000? And they trust you enough to do it, and that's okay. But let's just say, if you're just kind of getting into this, you want to look at the property due diligence. You want to look at the comps, the after repair value. What do they expect to sell this property for? Their scope of work, like we just talked about. If someone doesn't even have a scope of work, then you probably want to think, well, do I really want to lend money to this person? They don't even have a plan for the rehab. Or pictures, inspection reports. So how much due diligence have they done on the property? And then just looking at the numbers, the deal analyzer, which is what I mentioned when we were doing when we're talking about rehabbing, is you want to be able to look at all the numbers, make sure they have accounted for all the costs. What is their profit? What is their return on investment? What is your return on investment as a private lender? So those are all the things you want to take in consideration. And there could be more. I mean, sometimes lenders may check credit and things like that, but at least in terms of what are the minimum things you should do, these things would be what you should at least do bare minimum. All right, so Grace is going to come up and talk a little bit about rent to own.
So how many of you are new at investing in real estate? Okay. How many of you have been investing in real estate for at least 2 years? 5 years? 10 years? Okay, great. So of the last 3 areas that we talked about, is there an area that you've done yourselves? All of them? Some of them? All of them? Okay. All right. So how many of you have been involved with rent to own? Okay. All right. So in your perspective, has it been a good strategy or a bad strategy?
It's been a decent strategy on the lending perspective.
On-
Never had one cash out.
You've never had one cash out. Okay. Same?
I buy and sell on rent to own. I haven't got that first one cash out potentially.
That's awesome. How about, have you had any cash outs on rent to own?
I've got 4 contracts in my lifetime, so one of them, out of 4 contracts, one of them fell through, but so I still the available balance that one day for local. So I lost a couple of payments.
Okay. My experience with rent-to-own we've done 2 or 3 of them, and we've had 0 cash out. We've had no success on cash outs. However, we have had great success on our minimizing what we have to do to the property. And that's why we love it, because we don't have to worry about a lot of things. The best practices about rent-to-own that I think are very important is, number 1, a well-designed contract. A lot of people don't set this up correctly. We've used an attorney to write our contract, and I've researched several others, and we looked at them to get a good contract. But the contract is one of the most important things, because if you don't have a well-written contract, you don't have a well-developed relationship, because a lot of things can go haywire. So basically what you're doing is you're doing a lease rental agreement with an option to purchase, right? You understand that it's an option to purchase. So primarily, the rent-to-own tenant pays for all the expenses. We have put in there their taxes, the insurance. We pay it, but we bundle it in because we want to make sure that the taxes are paid and the insurance is paid. So we bundle that into our rent, but they're responsible for the payment based on how much their lease option is. We always get a fairly good lease option price up front, like a down payment. One of the things you have to think about that is that there's a reason they're doing rent to own. A lot of people really love it, and there are national websites where people can go on and look at rent to own properties available in their area. Personally, we probably get at least 2 or 3 calls a week for somebody looking for rent to own properties. And it's primarily because they had a bankruptcy maybe in the last couple years. They've just gone through a divorce. They have citizenship issues. And so they feel that this is the best way for them to actually own property.
Just saying, those costs like $4,000.
Exactly, right. Well, probably more than that. So we always try to get at least $5,000 down. Some people ask for more. We've found it hard to get a lot more than $5,000. How much do you typically get? Yeah, 5. Yeah, I found that 5 is about our barrier. When we go to 10, they don't have $10,000. But typically, I have a hard time getting more than 5,000. But I've seen people get as much as, I just had somebody get 75,000. So, but they're also responsible for any repairs and improvements. Now, that's a really big thing, because when we first started a couple of these, they would call us and say, "Hey, this is gone. This is out." Well, look at your contract. You're responsible for that. And so that's something that sometimes you have to educate them up front. They're no longer like a typical tenant. They are taking on ownership responsibilities. So when there's a repair, they're responsible for it. And so that's a real key aspect of why it's so much easier than just being a landlord. And it's a good option in terms of looking at a property strategy for your property. And it's a great exit strategy because you defer a lot of long-term and short-term capital gains by doing it this way. One thing that we've always done, and this is a key point, is the improvements have to be approved by the landlord. We've walked into situations where they were going to paint the walls or do things to the house, and they want to paint it purple and pink and different things, and it can become a real challenge. So we've always required that they have improvements approved prior to doing any improvements. And I really would emphasize this, because if you don't emphasize this up front, it can really get you into some challenges where they may start a porch improvement and then run out of money, and then all of a sudden there's a code violation, and then you're stuck finishing it because it wasn't done. So making sure up front that they know that they're responsible for all improvements and they have to get it approved through you before they start any improvement is really, really crucial. Lease is higher, and we talked about this because they are purchasing it. So we always try to make sure that our lease amount is the same and more than if they were getting a mortgage and what their monthly payment would be. So that's very, very crucial. You do not want it to be, less than what they would be doing if you were not the bank and they were at a bank. So tenant must fulfill lease obligation. We had one like this recently where they were late on a payment by 30 days, and they basically revoked their option to purchase based on our contract. Now they didn't understand that, and we tried to tell them over and over and over, you now do not have the option to purchase this property. You forfeited on your contractual obligations. That's really hard for them to understand. They think if they get all caught up that it's hunky-dory, and so you have to go through a notice process of notifying them that they are now not, they now have lost their opportunity to purchase the property. Their option has been revoked. That's very, very important to do that, because if you don't and you just go along that everything's still hunky-dory, and then all of a sudden they don't start paying and you're in a situation where you're going to have to do some legal ramifications, well, if you haven't notified them correctly, then you're as much at fault in terms of a legal situation as they are. It's not assumed. You need to give notices out, and that's very, very crucial. Before a tenant moves in, because they are doing an option to purchase, it should be no different than any other purchase. They need to do an appraisal, and they should do a home inspection. And you should document that, because that's crucial for future success. So here's some pros and cons, and we could talk for hours about this. Landlords having difficulty selling their property may find a buyer through a rent-to-own arrangement, and that's true. There are certain areas that can be more challenging, and this is successful in certain areas. During the option period, landlord enjoys a reliable long-term tenant. Well, typically they think they own the property and you're the bank, and so they're typically there 5, 6, 7, 8, 9, 12 years. Right? How long have you had a tenant? You only give them a 1-year option? Okay. You want them to cash out in 1 year. Okay. Variety? What like?
And I want to keep the paper. I want to keep it.
Right, that's kind of been our approach.
In one instance, I penalized him for cashing out early.
Uh-huh. So, like we were on a 15-year.
I saw a contract for deed, so there's a note with payments and everything.
Mm-hmm.
And most of mine are 10 to 15 years. I think 10 to 15.
Yeah. Yeah.
I like paper.
Yeah. The key is that you don't have maintenance costs. Now, we've had a couple of problems where we've had to go in and resolve it because they were short on cash, and we did not want to have a situation out there. For example, there was a roof issue. So we ended up going in and doing the roof issue because they had a tarp over an area, and our insurance company was doing an audit, and all of a sudden they're like, hey, we're going to cancel your insurance because it looks like there's a roof problem. Anybody have that situation occur before? And so we went in, we repaired it, and we added on for 1 year that expense onto their monthly payment. So, but you have to be really understanding about that. You can't say, oh, you got to fix it, because there are code violations and things like that you still are going to have responsibility for. There are tax advantages to this arrangement as opposed to lump sum payments, and that's why we love this strategy. We prefer to get a little over time than having to deal with a big 1031 exchange or something, and we're like, okay, now we have to find this property in 45 days, and we don't know what we're really wanting to do right now. So, you know, we've always had good success with this, and we think it's a great strategy, but there are pros and cons, and the key to all of it is setting up good documentation and having good parameters up front, and knowing that your tenant is a strong tenant for rent to own and not a weak tenant for rent to own. Because there are some people that should never be in a rent to own situation. Would you agree with that? Have you weeded those kind of people out and go, okay, there's no way, you know, this, you're just not the right candidate for this?
Save money down doesn't mean
That's, yeah, right. So that's kind of the overview of the rent to own. And do you guys have any other questions or any other thoughts right now? One of the next topics that we really wanted to talk about is syndication. And so I kind of wanted to get an idea of how many people in here have been involved in syndication? Okay. Have you researched syndication? Do you kind of know something about it? Is it something you'd kind of like to learn more about? Okay. Well, so we're going to have that as our next topic, and I'm going to bring some experts in from different areas that have been involved in it and doing it. A lot of them are, you know, been in the field for a long time, and it's a very interesting strategy when you want to bring a partner in on a deal because it's too big of a deal to do yourself. And we're starting to see more and more of this, like in multifamily deals, like $2 million, $3 million, $6 million and above, where it's a little bit pushy for two guys to do or two gals to do on their own, and a syndication model can work really well for them. So that will be our next topic, and we'll have some other presenters here as well to talk about that and some good information. So in the meantime, if you have questions about syndication or thoughts about syndication, email them to us, because then it helps us make a really good presentation for you in the future. Okay, thanks so much for coming.